All right, let's dive into a genuine economic mystery. I'm talking about a real head-scratcher, something that challenges the very tools central banks use to manage our economy. It's a puzzle that has stumped some of the smartest people out there for decades. And you know what? The solution might just be hiding in plain sight.
Okay, so we all kind of know the basic playbook, right? When the Federal Reserve wants to cool down an economy that's running a little too hot, it raises interest rates. This is pretty much monetary policy 101. The whole idea is to make borrowing more expensive for everyone, whether you're a family looking to buy a car or a big company trying to expand.
And logically, what happens next? If it costs more to borrow, people and businesses are going to spend less. And when there's less spending chasing after the same amount of stuff, demand cools off, and inflation, the speed that prices are going up, should slow down. It's simple, it's clean, and it makes perfect sense.
Well, here's where the story takes a really weird turn. For decades, when economists have run the numbers through their fanciest, most sophisticated models, they've stumbled upon this bizarre, totally counterintuitive result. After a central bank raises rates, prices actually go up for a little while. And this isn't just some tiny statistical blip. No, it's a stubborn problem that really gets to the heart of how we think monetary policy even works.
This whole thing actually has a name. It's called the price puzzle. And believe me, for years, it has been one of the toughest nuts to crack for economists who are just trying to build models that reflect the real world.
So here it is, laid out plain and simple. This is the textbook logic, the four-step dance that's supposed to be the bedrock of modern central banking. This is the chain of events everyone expects to see. But as our models have shown us time and time again, reality can sometimes tell a very, very different story.
An economist named Martin Eichenbaum gave it its name, and the price puzzle is exactly this. It's a situation where our models are basically telling us that tightening the money supply somehow leads to more inflation. It's like slamming on the brakes in your car, only to find the car speeds up. It just doesn't compute, right? It suggests something is fundamentally off, either with our models or maybe even with the data we're feeding them. And this just shows you the contradiction in black and white. On one side, you've got what all the theory books say should happen. Prices fall. But on the other, you have this puzzling result we keep finding in the data. Prices rise. Now, if you're a policymaker relying on these models to make huge decisions, this is a massive problem. I mean, how are you supposed to steer the economy if your dashboard is telling you that turning the wheel left actually makes you go right? So, of course, economists didn't just throw up their hands in defeat. They tried to fix their models. They rounded up a whole lineup of the usual suspects, if you will, to try and crack the case of the price puzzle. But as we're about to see, these old fixes just failed.
The thinking behind these fixes went something like this. Maybe, just maybe, the model is missing some key piece of information that the Fed has. For instance, maybe the Fed is raising rates because it sees inflation coming down the pipeline, which you can often see in rising commodity prices. So they tried adding commodity prices to the models. Then they tried adding data from futures markets to get a better sense of what people expected to happen. They even built these incredibly complex models that could digest hundreds of variables at once. And for a while it seemed like these fixes were helping.
And this is a huge but. Here's the key finding from the research we're digging into today. When you apply these classic fixes to the more modern economic era, let's say from the late 80s all the way to 2020, they just don't work anymore. The puzzle comes roaring back, consistently, robustly, no matter which of the old tricks you try. The mystery, it turns out, was even deeper than we thought. So if all the usual suspects are innocent, where do we look for the real culprit? Well, the answer might lie in a place that's been kind of overlooked for decades: how we actually measure money itself. Okay, this is really interesting. The standard way we measure money, you might have heard of it as M2, is what this slide calls a dumb wallet. It's pretty basic. It just adds up all the dollars sitting in different kinds of accounts and treats them all the same. So $1 in your checking account, which you can spend in a second, is seen as identical to $1 in some investment fund that's way harder to access. But Divisa money, on the other hand, is like a smart wallet. It's way more sophisticated. It gets that some forms of money are more money-like than others and weighs them based on how easily you can spend them. It's just a smarter way to measure the money supply.
And listen, this isn't some wacky, fringe idea. As you can see from this quote by economists Michael Bologna and Peter Ireland, there's a wide consensus among the experts that Divisa is just better. It's theoretically stronger. It works better with the data. And yet, it's almost never used in the standard models that policymakers look at. This, right here, is our crucial, overlooked clue.
So what happens when we take our old, kind of flawed measure of money and swap it out for this newer, superior one. Well, get ready, because the results are pretty stunning. All right, first up, let's run the experiment with the standard model. The key input here is the federal funds rate, which is the traditional way we measure what the Fed is doing.
And, yep, just as we've been talking about, the result is completely baffling. In the model, an expansionary shock, think of it like a rate cut, actually leads to a fall in prices. The price puzzle is there, loud and clear. The model is broken.
Okay, now for test number 2. We're going to keep everything else exactly the same, but we're swapping out the interest rate, and instead using our smart wallet measure, division money, as the main indicator of what monetary policy is up to.
And just like that, the puzzle vanishes. Gone. An expansionary shock, now measured as an increase in divisa money, leads to a rise in prices. A contractionary shock leads to a fall in prices. All of a sudden, the model behaves exactly as the textbooks always said it should. The car finally goes left when you turn the wheel left.
So the big takeaway here is crystal clear. The problem wasn't some missing ingredient, like commodity prices or something. The problem was that the main ingredient itself, our whole way of measuring monetary policy, was flawed from the start. The clue was hiding in plain sight this whole time. Now, I know this might all sound like a very academic debate, but it's not. This discovery has huge implications for how we understand our economy, especially the last 15 years or so, which have been, well, pretty turbulent. So let's just rewind the clock to the period after the 2008 financial crisis. To fight that massive downturn, the Fed did things it had never done before. It slashed interest rates all the way to zero and then launched these huge rounds of what they called quantitative easing, or QE, pumping trillions of dollars into the financial system. And during that whole period, interest rates basically stopped being a useful guide. I mean, they were stuck at zero, so what could they tell you? Models based on interest rates just couldn't make sense of what QE was doing. But models using division money, they show exactly what you'd expect. A massive, sustained, and totally sensible expansionary push from the Fed's actions. It really suggests division gives us a much, much truer picture of what was really going on in the economy.
The authors of the paper sum it up perfectly. By focusing almost entirely on interest rates for so long, we might have lost sight of the importance of, money itself. And putting a proper measure of money back into our models might just be the solution we've been searching for all this time.
And this really leaves us with a fascinating final thought to chew on. If our entire understanding of the recent past was clouded by what amounts to a simple measurement error, it really makes you wonder, doesn't it, what other huge economic mysteries could be solved not by inventing brand new theories, but just by doing a better job of measuring the world as it actually is. The answer to that question could literally change everything.